Hey TMFG community, John Iaconetti here with Carlo Cansino. In today's episode of ASK TMFG, we're going to be discussing the 10 financial principles we should abide by during these times. Remember, if you do enjoy our content, like, comment, and subscribe to the YouTube channel. We love doing these videos for you. In today's episode of Ask TMFG, we're going to be discussing the 10 financial principles that you should abide by, especially during these times, right? When we're going through periods like this with market volatility and potential recessions upcoming and all the negative news that you hear, it's important to think back to what can we control, and that's these 10 financial principles. So it's going to be a two-part series. Today, Carlo's going to get us started with the first 5. Next week, I'll be handling the second 5. Carlo, why don't you get us started?
Of course. Thanks, John. Yeah, so the 10 investment principles that you should be following to make your long-term investment journey a little more seamless, a little less emotional are these. So the first principle is embrace market pricing. So what does that mean? We think of the market as the most effective information processing machine. So essentially you have all this information about different companies that is, out in the media, it's on Twitter, it's in different publications, it's online. All of that information everybody is privy to.
Yep.
So when people are looking to buy or sell a stock, typically the share price that you are purchasing at or selling at is an accurate reflection of that company's worth. So the market as a whole, you should look at the share prices in the market as the most accurate reflection of the company's worth.
It really is just an equilibrium between, you got millions of people looking to buy a certain stock, you got millions of people looking to sell a certain stock, and that is going to find where the most accurate price lies. So how much are people willing to pay for it? How much are people looking to sell for it? And that's where we find our market pricing.
Okay, so that's the first principle. The market is accurate. Company share prices accurately reflect their value. Number 2, don't try to outguess the market. So you hear it all the time. People have their thoughts on where the market is going to go, what is a good buy, what's a good sell, and that sort of a thing. Research has shown that outguessing the market can be done maybe once or twice over a couple of years, but it can't be done consistently. Over the last 20 years, so from 2002 to 2021, there were just over 2,800 different US equity mutual funds. And so these equity mutual funds would perform over given years, but if there are some poor performers, what happens? The mutual fund company shuts them down. They don't want companies in their family of funds that have poor performance.
Yep.
So this is going to happen over that period of time. So if you think about how many of those funds out of the 2,800 I named from 2002, how many of them survived? How many of them maintained existence? And that's 44%. So just under half were able to maintain their existence. But that doesn't mean they outperformed the market. Only 18% of those 2,800 different mutual funds survived and outperformed the market. So if you look at it from another perspective, 82% of those 2,800 mutual funds did not outperform the market. And that's why you pay those high fees for those mutual funds or those actively managed mutual funds is to outperform the market. The same thing can be said about fixed income mutual funds or the bond market. Of the 1,500 fixed income mutual funds from 2002 to 2021, only 15% survived and outperformed the market. That means 85% didn't.
Yeah. It just goes to show, outguessing the market or those people that think they are able to outguess the market. It just makes for great content. It makes for great news. But at the end of the day, the numbers don't lie. It's very much more likely that we're going to underperform the market, just trying to maneuver and think that we're smarter than the millions of people making decisions on accurate market pricing.
Perfect. Number 3, try to resist chasing market performance. So I don't know if there's anybody out there that has purchased the Money Sense magazine or Money magazine and for the headlines that say, best performing mutual funds of 2022 or 2021 and thought that's the best way to build my portfolio. Look at the funds that have just outperformed. That should do me well over the long term. Well, that isn't necessarily the case. We've got data to tell you why it isn't. So when we look at the last decade ending 2021, we look at the top quartile or the top 25% equity mutual funds and their performance. Over the last 10 years of data for equity mutual funds in the US, when you look at the top 25%, of the last 5 years, if you chose one of the top 25%, only 1 out of 5 of those would be a top quartile performer over the next 5 years. Similar can be said about the fixed income funds. Only 1 out of every 3 remained in the top quarter.
Yeah, so right there, it's just the top 25%. There's a 20% chance of picking one of those funds. I don't like those odds. I might as well be picking the overall market and just focusing on the items that you can control.
No, great point to make there, John. Thanks. Number 4, let the markets work for you. I'm sure you've seen enough charting over the years to know that the equity market outperforms cash. It outperforms fixed income. It outperforms inflation. When we think about the numbers in particular, as of 2021, if we look at the last 36 years from 1985, $1 invested in the global stock market turned into $39 after that 36 years. Inflation in Canada turned into $2, and somewhere in the middle were the bonds, and they turned into $8. So again, the ride over that 36 years isn't linear. You don't see that growth in a straight line without any volatility. The volatility's there, but you are rewarded for being invested in something that will fluctuate, that will be volatile.
Yeah, excellent points. I mean, we've went through 2008. We went through even COVID in 2020. We've the tech bubble in 2001. We've gone through our reasons for the media to tell you, that equities are a bad choice or the stock market's not the place to be. But the numbers don't lie. You're going to be invested if you're looking to retire for the next 40 plus years. Equities is the place to go. There's always going to be that equity premium in excess of bonds and treasury bills and cash. Very good.
And the final principle for today's video, consider the drivers of return. Okay, what does that mean? In the equity market, academic research has shown that there are certain types of companies that outperform other types of companies. So, for instance, small companies outperform large companies. Value-based companies outperform growth companies. And high profitability companies outperform lower profitability companies. So when you're building a portfolio, it's not that you don't own the large cap companies, the growth companies, or the low profitability companies. You just put yourself in a position to outperform by overweighting those other types of companies that have shown a premium over the long term. In the fixed income market, there are factors to consider as well. Term, which is the length of time that you hold the bond. Credit, which means the probability that the issuer of the bond will pay back the principal. And thirdly, the currency.
These are all different factors that, just like the stock market themselves, are not going to work every single year. The important thing to consider about these factors themselves, just like the stock market, is they're not going to work every single year. Some years we're going to have a bad year in the stock market. Some years will be a good year. Same way that some years value will outperform and some years that growth will outperform. But historically, over time, value does outperform over growth over a longer expanded period of time. So the more factors we consider, and for a longer period of time, the more likely we are to outperform the market.
Perfect. I think that's a great way to summarize what we discussed in the principles. Like John said, this is part 1 of 2. We've gone through the first 5 principles that you should be considering in your investment journey. Number 1, embracing market pricing. Number 2, don't try to outguess the market. Number 3, resist chasing past performance. Number 4, let the market work for you. And number 5, consider the different factors or dimensions and drivers of returns. So that's today's Ask TMFG video. If you do like our content, again, we ask you to subscribe to our YouTube channel, give us a like, or give us some feedback with a comment. Until next time, I'm Carlo Cansino.
I'm John Iaconetti.
And this has been Ask TMFG.